Hey traders and investors, this is Mike Gagney, CTA Manager of Magna Libra Capital Advisors and author of the Econemotions.com blog, where we try to bring you non-linear economic, financial, and trading insights, enticing you to think outside of the box. At Magna Libra, we run a global macro discretionary program that utilizes a long-short relative value approach. Feel free to visit us at magnalibra.com to learn more about our program. Okay, let's dig into a few things that have piqued our interest this week. We feel that investors need to be fully aware and cognizant of the investment landscape that is currently controlled by the global central banks. And the recent bout of economic volatility should be here to stay as the Federal Reserve shifts its tightening campaign and reverses its course rather quickly here over the coming months. Speaking of the Federal Reserve, they are meeting this week in our hometown Chicago to review current monetary policy, as this Bloomberg article points out. It'll be interesting to see what these guys decide to come up with as a group of academics are put together with all the Fed heads here to discuss new and exciting research and complex topics. One thing will be certain, whatever they come up with will be well behind the curve, and as the past has consistently proven, the Fed and their 700 PhD in quants are chock full of terrible prognostication capabilities. In fact, we have this chart here to show you just how severe the 360-degree change has been over the last few months, as all the quants that were predicting Fed continued tightening, which was nearly 80 basis points at the end of last year, as you can see here. Here's the end of last year. Close to 80 basis points of tightening was expected. Now they're calling for a 50 basis point reduction or easing. And look at this. Look at this spread here. This is crazy. 80 basis points to now of a tightening to now expecting more than 50 basis points worth of a cut. With this newly found trajectory, this chart points out the overexuberance of the S&P 500 market, which you can see here, in comparison to the new and expected path of lower rates. Who said markets are efficient? BS, we know better. Basically, the question becomes, do you believe the bond markets down here, or the equity markets right now, which are still sitting up here? Well, not anymore. This chart's a little old, a couple days old, 27.96. The S&P has come down a little bit from there, but you can see the wideness of the spread here denoted by the blue arrows. You know, we informed our readers and listeners of our key yield curve metric, and we have the chart here. The chart is the U.S. 10-year note versus the Fed funds rate, which we have right here, with our triangle highlighting the equity death cross. This is a decade-long move in the making and not something to be trifled with. As our readers and viewers know, this is a very important indicator. And in fact, when you look at the updated version of this chart on Bloomberg, you can see now, but before we get to that, let's just explain this a little bit here. So here we have the Fed funds rate, and here we have the 10-year yield. We've been waiting for this cross to give us a little bit more of an indication of equity market overall stress due to our over-leveraged, over-indebted, financed economy. When the short-term rate rises and your interest payments rise, well, this causes a lot of stress on the leveraged market. And so we thought that this was an appropriate metric, and that's why we did the chart here. And this triangle basically highlights that. Now moving to where we are currently. As you can see now, the U.S. 10-year yield is inverted to this Fed funds, meaning it's trading 37 basis points below. And the last time this happened, well, you guessed it, early 2008, as indicated right here. So here's the inversion line of the 10-year versus the Fed funds. Back in late 07, early 08, you can see, actually that was the last time it was still inverted. It was just coming out of that here in the housing crisis, as it became inverted in 06, and this is when Ben Bernanke said, "I've never seen a housing downturn in the U.S. economy." Yeah, you're full of crap. Well, it happened, and a lot of people got smoked. A lot of houses are still not back to these levels, even though we're some 12 years out, 13 years out from this. So this is what we're talking about. The Fed bought a whole decade of TARP, QE, and now we're back to here. So let's just consider this 06, and so we still have some time. I mean, the markets didn't really top out until 07, 08-ish here, and then obviously 09, the Fed decided that enough's enough. Let's do QE, let's do twist, and let's just backstop everything and buy everything. In a coordinated effort with all the global central banks, of course. So as you can see, that chart we put out in March was this period right here. As you can see, this is 2.5%, and now the 10-year yield has come down to 2.12. So that's where we sit, and this is what we're talking about, is this short rate Fed funds is now inverted compared to the longer term 10-year rate. So for those of you that don't know, the bond market is so important because it's the key to our overfinanced and leveraged debt-based system, as we have said. As this Zacks.com graphic shows here, the U.S. bond market, and that's what we have here, is 10 trillion larger, standing at 40 trillion with the market equity cap of only 30 trillion. As you can see, this is a big reason why we tend to focus our attention to the bonds when the market sentiment starts to change, because it's much larger, has a larger effect, and an over-indebted leveraged system, this takes precedent above all else. If you can't fund it, you can't pay for it, well, you got to discount asset prices, period. Another chart to solidify our overall equity market view and why we have seen recent uncertainty. Look at the size of the inflow into the money market funds last month in May. A whopping $100 billion over the last 5 weeks alone. Talk about sell in May and go away. Well, we're definitely seeing it this year. Look at how it compares to all the prior years. I mean, we're talking about 10x here, guys. That's a big move. And if this isn't enough evidence, perhaps this chart here, showing a record global equity fund outflow, just giving you a quick glimpse into the severity of the real selling. Paging the President Working Group, as we always say here. We used to joke that and CNBC would always say that the Federal Reserve never intervened in the market, and they were always saying that that's conspiracy theory, and now we know it's conspiracy facts. So that's what we mean by the President's Working Group, because that's the committee that decides all that, in probably cahoots with Citadel, using them as their fiduciary. Anyway, we know they've been mopping up this selling with corporate buybacks, but it's not having the same buy the dip effect now, is it? So here we go, negative 250, and we know corporate buybacks are enough to take some of this on, but the markets have not risen as they had in the past. So we feel the buy the dip is completely over, and now we're in a topping motion, which we'll point out here in a little bit. We can also see that PIMCO zero coupon bond ETF, which we've can see is a clear outperformance this year, up 14% in 5 months alone. This ETF has performed very well and has been a big beneficiary. So just to think, up 14%, and people say, well, why would you buy a zero coupon bond? Why would you buy bonds? They only yield this. Well, they always forget to mention capital appreciation, but equity guys don't want to tell you about bond equity appreciation. They just look at coupon rates. But we know the truth, and here we go, and now to you. So keep this up on your radar. As interest rates drop to zero, this one is going to be a mega outperformer. So we hope the picture is becoming increasingly clear, and that the equity markets have been telling us that the future is indeed uncertain. We also want to point out that the fact that equity markets have been putting in a topping formation for quite some time. People just think like, oh, the top is just recent, but not. This really isn't the case. This chart puts the top almost a year and a half ago. That's how long this formation has been taking place. As you can see here, January 2018. Here's the top. This is the global equity market cap. This is about 86 trillion. We've dropped in that big December move, lost about $16 trillion, and then we went back up to 80, and now we're back down to like 75 or so after last week's move. So this topping formation hasn't just taken place over the last few months. This has been a year and a half in the making, if not longer here. So we hope you see this, and we can point this out for you here. Before we get into some of the technical charts, MagnaLibra decided to do a little bit of digging into some potential black swan events that nobody's really talking about. We kind of pride ourselves on finding things in places where other people, may not look, or may not have the opportunity to look, or who wants to look through a 500-page annual report? Not many people. But we do, and so we decided to dig into Deutsche Bank's annual report, and here's what we found. We found a whopping $301 billion on the hook for that nobody seems to be talking about. Now, maybe UBS found it too, and that's probably why they said no thanks to the merger. So we suppose the negative $250 billion ECB Target 2 balance is about to get a whole lot bigger. But we just want you guys to take a look at this, because nobody digs into these reports, but you find juicy gems here every so often, and this is one that we found. So just to look at this, so here we go, $301 billion. Negative market values from derivative financial instruments. What does this mean? Here we go. Trading liabilities and derivatives not qualifying for hedge accounting balances are recorded at fair value. The group believes that this best represents the cash flow that would have to be paid if these positions had to be closed out. Now, where is Deutsche Bank going to be coming up with 301 billion? I don't know. And you know this number will balloon as soon as credit spreads blow out. So, you know, this is stuff that people need to be cognizant of, and why we can't stand central bank intervention, because it allows and accounts for this kind of activity. To take it just a little bit further, we dig into the archives and we found this another little juicy graphic: systemic risk among the GSIBs. And you know, what this is basically telling us here is that they have 48 trillion in derivatives. And yeah, some people will say, well, those aren't netted, and this, if it's not really that high. But you know what? They only have 588 million in loan loss reserves. So you do the DV01 leverage math there, and you can see that 1 basis point was worth a ton of money. And we know with Deutsche Bank's stock under $6 that this stuff is going to be becoming increasingly important as we move forward. And it's part of the reason why we feel that interest rates are starting to move a little bit lower and quicker and accelerating, and it kind of reminds us of LTCM in '98. So don't be surprised at this, and we want you to be cognizant of it, and don't think that this is something that turns around quickly and goes away. This doesn't. This gets exponentially worse and accelerates exponentially quicker. So you want this to be on your radar. But we don't really want to, truly pick on DB, but we felt their infographic here was appropriate. Also, while digging into their annual report, we also found another little nugget here. And last year they decided to increase their sovereign exposure to Italy. Why do this? And it's crazy to think about, but maybe the Deutsche Bank knows the ECB has their back, and they think they're going to, as interest rates become further negative, that this isn't going to blow out. But you never know. As we see here, the Italian 10-year risk spread over German rates is now up at 291 basis points. Back when they did this, back in 2018, they were down here at 150. So now you can almost see a 2x risk spread widening. And what that'll do to this number is it'll exacerbate this loss, and exacerbate it very quickly, as all leverage does. So, to increase their exposure, $1.7 billion worth. It says 1.5 billion euro here, but we converted it. But, I don't know. Is Deutsche Bank way too big to fail now, and they're going to be, having to get bailed out here? Well, we'll see. Their stock is not doing well, and so we'll keep an eye on this over the coming weeks to see what happens. All right, let's get to some technical charts, and sticking with Germany, let's look at the DAX index. We like to look at this index. We follow European time zone markets a lot, and for our precursor to see what happens in New York. And this is a pretty big index, so most of our readers and viewers know that the 11839 area was our line in the sand, sort of. It was a prior high. They broke through it. Now we're back down, putting in this kind of head and shoulders topping formation. We don't have the trend line here, but if you drew this here, we it's kind of came in at the 50 period VWAP as well, and they broke that at 11972. And now our next stop will be kind of 11570, 11600, where there is a gap down here. So you can see it kind of right here on this chart. So we expect that to get filled. We expect it to kind of meander down here, and we'll play wait and see mode to see if anything else transpires in terms of Deutsche Bank or any more sovereign credit risk. So that's kind of our first technical chart here that we want to look at. And when we look at the S&P 500 here, we can see that the 50 period VWAP has been hit, and we've traded a little bit below there now, and this becomes our continuation magnet. So that's what we like these VWAPs for. It becomes our trade around a relative value risk of, and it kind of seems like maybe our bull and bear line a little bit, but we are ultimately here on the bearish side. But we would expect some chop around here. Even if the market continues to falter, we can always count on a bit of pain trade against this trend. So we wouldn't be surprised to see a trade back up and through here, as nothing moves in a straight line, and they always make the selling difficult, as they make not as difficult as the buying on the way up has been. As you can see, these linear straight up move, but these downdrafts go down and just come back up as quickly. But we aren't so sold on that's going to happen again here. The technical picture has certainly deteriorated, and the Fed is in not hiking mode, but now in reversing that course, and that should cause everybody a little bit of nervousness of asking how deep is the problems, how deep did they go, and how bad is it out there. So that's what people continue to assess. Um, the overall 2019 equity move the first half of this year has been led by the techs, as we can see in this next chart here. This one we like to look at a lot is the FANGs versus the overall S&P market. Once again, you can see our 50-period VWAP here, but this chart has also been in a downward trend. It broke out of this upward trend that it spent the first 5 months doing, actually first 4 months, Jan, Feb, April, and then May they kind of fell out. Started with Google, that one earnings report that they had, and then that really hit them down, and then we just put the downtrend here, and it's been holding ever since. At least the last month. So we continue to watch this, and this descending trend channel seems to point to a continued disappointment out of the tech sector. So we can add to the fact that the U.S. government is going to look very deep into antitrust measures into some of these big tech giants, and we expect this rhetoric to increasingly weigh in on the sector moving forward. So keep an eye on this one. We feel that the tech has come. It's coming off its highs, and it's really been up pretty big against the S&P this year, and so we're just starting to come back. So this is, once again, looks like just a topping formation, so something to keep an eye on for you traders and investors out there. Moving over to fixed income markets, we can see the continued inversion and flattening of the U.S. Yield curve here. This chart shows the collapse of the U.S. 10's 3-month spread, now hitting negative 21 basis points, down from 100 basis points last year. This is a massive move. It's caught a lot of people off guard. It didn't catch us off guard because we felt that the Fed was going too far, and we've always used the mantra of QE forever. We know they can't really raise rates. They're just playing baton, passing off the baton with the global central bank. So, but this negative spread is a disaster for leveraged finance, and that's the reason why we continue to see asset prices discount future value. So, this is telling us the recession is coming. It's probably already here. It's been here. Although we talk about a two-tier economy, where the ultra and wealthy, the elites, they aren't affected by what goes on daily, but the overall, rest of the people are. So, and that's kind of, we're seeing the effects starting to weigh in on the overall economy. And you can see our little text here. Sorry, Fed, the bond market makes the rules, and this is what's really forcing their hand. They probably don't want to cut it as quickly as they had to, but we know the truth, and this is why the Fed is backs against the wall here, so they're going to have to cut rates probably soon. And I don't think anybody's looking for a 2019 rate cut. We tend to think that they're going to go 50 basis points each time, so I don't know whether it comes in next month or September. They're going to do 50 basis points, we feel, because the bond market's moving too fast for them here. This next chart truly captures the collapse in U.S. government yields as the 10-year note. You can see as I put in what's a high over here, as that equity market was running up last October, back up near 325 basis points, or 3.25%, and now we're dropped all the way down to 2.13. So this is a massive collapse in just a little over 7 months. But once again, we know QE forever. That's the theme, and the world only knows one way, and actually the central banks know only one way, and that's down to zero. Because that's all they know, and when you're a hammer, everything's a nail. So that's what they do, and that's what they will do this time as well. But we don't think it's going to bounce the equity markets as quickly as they think it will. And we don't think the Fed likes to overpay when they do QE anyway, so we expect a little more pain there. So with the Fed ready to embark on QE forever, let's see how the gold markets responded. Well, it's breaking out. We talked about 1288 being a pretty big level, and I think that's kind of somewhere right in here, and we busted well above that here with the recent bout of volatility. And we think that this, if you look at a longer, we don't have the chart here now, but if you look at the base that this has been putting in, you can kind of see it here a little bit above 1280. We can't, even with the the stocks ran up, and then the gold kind of went with it, to be honest, and it was buy everything again, and then all of a sudden this is kind of in this downward trend channel, and now we're breaking above it. So we got to be we're going to move our little level up here to above 1296 as our line in the sand now, backed up by the VWAP, but we're going to back and fill here down to 1296. Yeah, maybe, but we might keep popping higher depending on how nervous global investors get. So this is one for you guys to keep an eye on, and we think this has a long way to run. Finally, let's look at the crude oil. Crude oil is kind of putting in a similar move as last year, and perhaps it's discounting global slowdown as well. This too doesn't bode well for the equity markets, as we said, as energy is the main driver of global output in our book, and thus if this continues to falter, then we feel equity prices will continue down as well. One thing this chart does point out is that it's off its highs late last year. It lost 41%. So let's be mindful of the severity of this move. See this move here. You know, could we get a similar move here? And if we do, where will it go? You know, a similar move here is down to 41 bucks. We do like this fib level here to be reached at $49. We would think that that'd be some, you know, at least a technical stopping point for the overall market there. So that's another thing that we've been keeping an eye on. Okay, so that's it. The next that's it for the technical picture here. The next infographics deal with China, and this first one puts on display the large jump in food inflation, hitting 6.1%. And given the amount of people there, this probably ain't going to go over very well. So, you know, we know China's had their troubles over there with the tariffs, and you know, people here clamoring. The mainstream media is saying, "Oh, it's you know, Trump's just, you know, he doesn't know what he's doing. Why would he do this?" But you know, Trump, you know, he knows the truth, and we know that this imbalance can't keep going on forever. So this next infographic we did was pointing out the falsehood that China can sell their U.S. Treasury bond holdings, because people are always saying, "Oh, if they piss off China, they're going to sell our." No, they can't, and this will tell you why. Look at the size of the bank liabilities. I mean, this is a massive move, 20 trillion in, let's see, 7 years. So, you know, with this debt and with the severity of a downturn, you know, depending on the severity of the global downturn, they can't afford to get rid of it. You're going to sell treasuries, AAA rated securities that you know are basically good as gold? No, I don't think so. They can't afford to do it. They won't do it, and that's a false proclamation. So we just want to make that point very clear here, so when you see people arguing that point, we know the truth here. You know, so we can see here that the PBOC has been in overdrive, printing yuan to save, you know, the domestic, you know, financial infrastructure. But you know, there's real risk out there, so we are not so sure how much we can trust from over, you know, their data over there. So we just know that if they hold 1 trillion, well, yeah, I guess it's around 1 trillion of our treasuries, they're not just going to go and sell them because, well, they can't. Not without hurting their financial position. So, all right. I mean, that's it. That's all we have for you. We're going to keep cognizant of the developments this week. Thank you for joining Magna Libra on this week's Economotion. But before we go, we thought we'd point out this article from Zero Hedge. I thought it was pretty interesting. Now, we're big Ray Bradbury fans, Martian Chronicle fans, and we're constant sky observers and Electrical Universe fans. And with that being said, when we see articles like this, we have to be very skeptical as to what agenda is truly trying to be pushed, what narrative is being spun, what are the powers that be trying to set us up for. Anyway, we've heard increasingly government-led chatter about UFOs and UFO phenomenon, and military guys coming out saying they don't know where these things are from, and it all just seems a bit forced to us. Anyway, give it a read, see what you think, and as always, open your minds, expand your horizons, and we hope you enjoyed this week's Economotion. I'm Mike Gagne of Magna Libra Capital Advisors. Feel free to reach out to us at any time. As our tagline says, we don't want to be a large portion of your portfolio, but rather a significant portion of your alternative asset allocation. Cheers, guys. Over and out.